Hello and welcome to Smart Capital. If you're new here, this channel is all about helping you understand the world of money, clearly and intelligently. We break down complex financial topics into simple, actionable advice so you can make smarter decisions with your wealth. Today we're going to pull back the curtain on something that might seem intimidating, but is essential for every aspiring investor to understand. How does the stock market really work? We'll demystify the jargon and get straight to the core concepts. By the end of this video, you'll have a solid foundation for your investment journey. So, make sure to hit that subscribe button and turn on notifications so you don't miss our next videos on finance and investing. Let's dive right in. First things first, what exactly is the stock market? At its heart, the stock market is a massive, dynamic marketplace. It's a place, both physical, like the New York Stock Exchange, and increasingly digital, where investors from all over the world come together to buy and sell shares of publicly traded companies. Now, what's a share? Think of it as a tiny slice of a company. When you buy a share of, say, Apple or Tesla, you are literally buying a small piece of ownership in that company. You become a shareholder. This is where it gets interesting. If the company you've invested in does well, it innovates, grows its sales, and becomes more profitable, the value of your ownership slice, your share, generally increases. On the flip side, if the company struggles, faces tough competition, or makes poor decisions, the value of your share can go down. It's a direct link to the company's performance and future prospects. Imagine a global bazaar, bustling with activity 24/7. That's essentially the stock market. Millions of people are constantly exchanging ownership in thousands of different companies every single day. It's the engine of modern capitalism, connecting companies that need money to grow with individuals who want to put their money to work. It's not just a game for Wall Street experts. It's a system that anyone can participate in. So we know what the stock market is, but what makes the prices bounce around all day? If you've ever glanced at a stock chart, you've seen those jagged lines going up and down. Stock prices are constantly in motion, and it all boils down to one of the most fundamental principles in economics: supply and demand. It's actually quite simple. If there are more people who want to buy a particular stock than there are people willing to sell it, the price goes up. There's high demand and limited supply. Conversely, if more people are rushing to sell a stock than there are buyers, the price goes down. The supply overwhelms the demand. But what drives this supply and demand? It's not just cold, hard numbers. Behind every buy and sell decision are human emotions: optimism about a new product, fear of a recession, confidence in a company's leadership, or doubt about its future. This is why the stock market is often called an emotional machine. A positive news report can create a wave of buying, while a bit of negative speculation can trigger a sell-off. Understanding this psychological element is one of the most important, yet often overlooked, keys to becoming a successful investor. It's about learning to see past the short-term noise and focus on the real value of the company, rather than getting swept up in the market's daily mood swings. The best investors don't just analyze spreadsheets. They understand human behavior. Now let's look at this from the other side of the transaction. Why do companies even bother to issue shares in the first place? Why would a successful company want to sell off little pieces of itself to thousands of strangers? The primary reason is to raise money, or what's known in the financial world as capital. Growing a business is expensive. A company might need funds to develop groundbreaking new products, build new factories, hire a larger team of talented people, or expand its operations into new countries. Instead of going to a bank and taking on debt with interest payments, a company can choose to go public by issuing shares on the stock market. This process, called an initial public offering or IPO, allows the company to sell these new shares to investors. In exchange for their cash, investors receive a small share of ownership. It's a powerful, symbiotic relationship. For the company, It's a way to get the funding it needs to fuel its growth without the burden of debt. For investors, it's an opportunity to share in the company's future success and potentially see their investment grow significantly over time. It's a win-win that has powered innovation and economic growth for centuries. So, you've decided to become an investor. You've bought some shares. The big question is, how do you actually make money from this? There are two primary ways that investors can profit from owning stocks. The first, and most well-known, is through capital gains. This is the classic buy low, sell high strategy. A capital gain is the profit you make when you sell a stock for a higher price than what you originally paid for it. For example, if you buy a share for $100 and sell it a year later for $150, you've made a capital gain of $50. This is how many investors build their wealth over the long term, by identifying promising companies and holding on to their shares as they appreciate in value. The second way to make money is through dividends. Not all companies do this, but many established, profitable companies choose to share a portion of their profits directly with their shareholders. These payments are called dividends. They are typically paid out on a regular schedule, like every quarter. Dividends provide a steady stream of income for investors, even if the stock price itself isn't moving much. It's like getting a small reward just for being a loyal part owner of the company. Successful investing isn't about getting lucky with a hot stock tip. It's a discipline built on patience, a deep understanding of what you're buying, and sticking to a clear, long-term strategy that aligns with your financial goals. This brings us to one of the most crucial concepts in investing: the importance of time. In the short term, the stock market can feel like a casino. It's unpredictable, volatile, and often seems to move without any rhyme or reason. A company can report record profits, and its stock price might still go down for the day. This short-term randomness can be frustrating and scary for new investors. However, when you zoom out and look at the bigger picture, a different story emerges. Over the long term, the stock market has historically shown a consistent upward trend. The daily jitters and corrections tend to smooth out, revealing a pattern of growth that is tied to the overall growth of the economy. This is why you'll often hear seasoned investors say, "Time in the market beats timing the market." Trying to perfectly predict the market's peaks and valleys is nearly impossible. But by staying invested through the ups and downs, you give your money the best chance to benefit from the power of compounding and long-term economic progress. Patience is truly an investor's greatest superpower. So let's quickly recap what we've learned today. The stock market is a vast ecosystem where you can buy and sell ownership in companies. Prices are driven by the timeless law of supply and demand, which itself is heavily influenced by human emotion and psychology. Companies issue shares to raise capital for growth, creating a win-win for both the business and its investors. And as an investor, you can profit through both capital gains and dividends, with time being your greatest ally on the path to building wealth. It's not a get-rich-quick scheme. It's a living, breathing system driven by companies, investors, and their collective hopes and fears. If you found this explanation helpful and enjoyed this video, please give it a thumbs up and share it with a friend who's looking to start their own investing journey. And of course, if you haven't already, subscribe to Smart Capital to keep learning how to grow your wealth intelligently. Thanks for watching, and we'll see you in the next video.